Welcome to the Daily Update. We'll go over the action in the market for Friday, March 31st, and then we'll see how things look for Monday, April 3rd. We had another solid up day. One of the things that I was pointing out is there is a real discrepancy between the rise in the S&P and the rise in the home builders. That relationship improved a little bit, but it's still giving us a warning sign. We're also quite overbought right now on a short and intermediate term basis. Not quite there on a long-term basis yet, but maybe we've gone up a little too far too fast. Some of this can be expected. It was the last trading day of the week, month, and quarter, so things are being shored up in that regard. But nonetheless, we're looking at a real overbought condition. We have some major overhead resistance that I'll talk about and have a lot of charts to cover in this video. First of all, just to update some things, between April 22nd and May 11th, I will be traveling. My intentions are to do the daily videos. I'll also do the other videos like the weekly video and the intermarket analysis video, as well as the deep dive video, if I'm able to do that. I do have a podcast, just a carbon copy of what you're watching right now, but if you're into listening to podcasts, that may interest you. Also, in the videos as well as the podcast, I have a PDF of all the slides and charts that I use in the description below each video. Also, I have a private Facebook group. I'm trying to make that a little more active right now. If you would like to join that, please send me an invitation through Facebook and I'll be glad to add you. I'm also thinking about having some market outlook, either quizzes or polls that I put on the community tab. I'm going to work on that over the next couple of days and I'll launch that and talk about it in the next video. We can go over what do you think is going to happen a week from now, 2 weeks from now, a month from now, just to get an idea. And there might not be much participation at the beginning, but the hope is that more people will want to participate with this. Things like, do you think the banking crisis is over or is there still some left to go? Just yes or no type of questions that will be asked in the poll. Let's go back and talk about what happened. Right at the open, we had a higher open, not much of a gap, but prices quickly shot up right after the open. This was the first day that we've actually seen that, where a lot of the gains occurred during the night and then we just gapped higher. Well, we actually saw some upward thrust in Friday's session. Prices went above R1 at 4,062, also went above R2 very quickly at 4,073. As the day went on, prices kept drifting higher. We got up to R3 at 4,098, and we were able to close above 4,100. We were up 1.44%, but on below average volume, and that is a concern. This whole rise that we've seen over the last week or so has been on a decrease below average volume basis, and that is a concern. The technicals are quite overbought right now, and I have lots of charts to show you. They are positive, but we're looking at some kind of a pullback. We'll just have to see if things start to fall back. Is that going to turn into a move in the opposite direction, or are we just falling back before we're getting set to go higher? The markets are still really fixated on inflation and interest rates, as well as this whole banking crisis. Is it over? Is there more still to come? Nobody really knows the answer to that right now. And then any Fed speak that we may get. Here's a look at the intraday action where we did have a higher open above R1 and R2. That wasn't really that hard because Thursday's session, the range between the high and the low was not very great. So the R levels for Friday's session were not all that far apart either. We got above R2. We drifted higher. Didn't really see a lot of selling come into the market. Eventually worked our way up to R3 and closed above R3 and even above 4,100. Here's a look at value versus growth. Both were up. Where value tended to outperform a little bit. Here's the closing basis, where growth did a little bit better with the large caps. They were the same in the mid caps, but growth really underperformed value with the small caps. Here's the intraday SPY 10-minute chart. After we closed on Thursday, we maintained a lot of the gains and the futures drifted higher. That led to the higher open on Friday. As we were going up, we came back down a little bit, but ended up closing pretty much at the high of the day. And then we drifted sideways until the market closed for the weekend. What are some comments that we can make? Inflation data that was released on Friday was taken as favorable. Volume continues to be below average. We've seen that this whole rise. The S&P was able to regain the 4,100 level. And on a short-term basis, we have the moving average study, the shorter-term moving average that I'll show you, the advanced decline ratio, the rate of change going back 5 as well as 10 periods, the Stochc RSI, stochastics, we have the Williams percent R, and the RSI based on 9 periods are all extreme positive. On an intermediate term basis, we have the Swinland Trading Oscillator, the McClellan Oscillator, and the larger McClellan Oscillator that looks at the NYSE, the PMO study, the CCI 14, as well as 20. The dollar was up and interest rates were down. The idea that interest rates were down gave some support to stocks. Typically, the dollar going up might provide some headwinds, but it did not do that in Friday's session. The Home Builders ETF, that negative divergence, it is showing some improvement, and I'll show you that. We still have the 30 to the 5 that's gone back to being normal, where all the rest of our yield curves remain inverted. Sentiment is now kicked up to neutral. We're at 49 where we had been at 44. Looking at our trend, we are positive, and it's starting to get a bit stronger now. Unfortunately, we're at an overbought condition, and if we do start to pull back, we're going to go right back into a strong trendless environment because the ADX is still below 20, our bias is positive, and our momentum is positive. Here are the economic reports that came out. We had personal income up 0.3% as expected. Last time it was up 0.6%. Personal spending came in down a little more than expected at 0.2%. They had expected it to be up 0.3%. Last time it was up a full 2%. The PCE prices came in a little less than expected at 0.3%. They expected 0.4%. Last time it was up 0.6%. The core PCE prices came in a little less than expected at 0.3%. They had expected it to come in at 0.4%. Last time it came in up 0.5%. The Chicago PMI came out. Now we're under 50, so we're still contracting. It came in at 43.8. They expected it to be at 42.5. That's a little bit better than expected. Last time it came in at 43.6. Consumer sentiment came in at 62, a little worse than the 63.4 that they had expected. Last time it came in at 63.4. The thing that's making this look a little bit more positive is when people look ahead as to what will happen with inflation. They think inflation will be at 3.6%, where they had thought that it would be at 4.1%. Looking at some Isabel net charts, we're seeing a real divergence from earnings of what they think are going to happen and what earnings actually are. This chart just suggests that earnings don't survive recessions. That's part of the reason we go into a recession. There's a slowdown economically and earnings go through to the companies, which ultimately come through to stock prices. Another chart is actually seeing some outflows in equities. Now, this might change after the positive week that we had. We're also seeing a correlation between oil prices and CPI. Of course, they shifted ahead 6 months. The red line here is oil, and that's been going down, and the CPI has also been going down as well. And then looking at April, it tends to be a positive month overall. They say here it's rarely lower in a pre-election year. Typical return is 3.5%, and it's positive 94.4% of the time. So we have some good seasonality that I'll also address later. Since we had an end to the first quarter of 2023 being positive, if the second quarter, the end of June, ends up being positive, that might mark a new bull market as far as this chart is concerned. We're still looking at this thing called equity risk premium. How much extra do you get for investing in stocks, which are riskier than risk-free investments? And it's really rich relative to the very optimistic EPS expectations. The yellow line is the forward against the trailing earnings per share, and this is inverted, where the S&P shows the equity risk premium on a year-over-year basis, and there's still a pretty wide gap between the two. They have a tendency to go in the same overall direction and not get all that far apart from each other. Here's the MBA Purchase Index. This is for houses, where we're seeing a little bit of strength coming back into real estate. The dividend yield. This is dividends paid just on the S&P. In the U.S., it's still very low at under 1.75%. Emerging markets pay higher dividends, and then developing markets, if you take out the U.S., they come in second place, which still is not very good as far as dividends, but that's what a lot of people use for their investments. Edward Yardeni came out with his latest email. He says, through the past 2 weeks, through March 22nd, banks borrowing jumped $570 billion to $2.52 trillion. And here's the chart, total banks really going up. Borrowings by large and small domestically chartered banks rose $266 billion and $300 billion over the latest 2 weeks. So we're seeing a lot of money being borrowed from the Fed into small as well as large banks. Does that mean this banking crisis is over, or is there still more to come? He also points out where he says we track the activity of the Fed's liquidity facilities by simply subtracting the central bank securities holdings from its total assets. From Wednesday, March 8th through Wednesday, March 29th, this figure rose by $386 billion to $830 billion. The Fed flooded the banks with liquidity to extinguish the banking crisis fire. And I've shown other charts that show a real spike up where we had been seeing quantitative tapering. Well, a lot of that has been wiped out by a lot of this borrowing, especially when you just compare it to the Fed balance sheet. Here's another chart showing all commercial banks in trillions of dollars. The blue line at the top is the deposits, the red line, loans and leases. Then we have securities owned by banks, and then borrowing by all banks, which is really spiking up. Looking at the Real Investment Advice blog, their headline says the banking crisis is how it starts, recession is how it ends. We see way over on the right-hand side the same thing that we just saw, a real increase in the banks borrowing from the Fed. Here's a historical chart showing how we're going above a lot of these other areas. If you want to pause the video and just look this over, that might be helpful for you. This is a chart that I've also shown before, but it's been updated a little bit. This is rising up, so it just shows that tightening standards for banks are still going higher and higher. That leads to less money out in the system. That can also feed over into especially small businesses that need to borrow a lot of money. This chart also suggests that lending standards are getting much tighter as this orange arrow continues to go up. That's the average. Here's another historical chart where it says Fed policy pivots and bear markets. Notably, most bear markets occur after the Fed's policy pivot. We can look back to 2018 and even after the COVID plunge, where that was kind of its own situation. But doesn't mean that it will always happen, but it might end up happening this time, and it usually does happen. Here's the generally accepted accounting principles earnings and GDP growth, how they tend to go in the same overall direction, and they're both declining. And this is the real S&P 500 when you take into account inflation with recessions and what has happened. Then some of our charts to show you the decision point updates. We did have a change in the trend model. In the short term, we're positive. Intermediate term, we're positive. We're still negative in the long term. With the PMO signals, we switched to positive on the 27th of March. We're remaining positive in the intermediate term, but in the long term, we're still in a downtrend. Here's the Ulcer Index showing how fear is dropping off and now going sideways. That's showing more complacency in the market. The VIX continues to fall with the update, both on the line chart and on the bar chart. And volatility, it actually ticked up slightly on the line chart. Is the VIX sensing something right now? The equity put call ratio continues to fall as people are not hedging their investments using puts. But we really look at the 5-period simple moving average where it continues to decline. And here's the long-term chart where we spiked up above 0.8. We're coming back down now, and that has given some support to the market. The latest reading of the active asset managers shows that they're getting a little topsy right now, a reading of 65.5. This information is a week old, so it's probably going to go higher and possibly go into the extreme positive camp. We're seeing a real drop-off in fear overall as the market's been going up. The high beta stocks are also not really performing as well as they had been. So we're more in a risk-off posture right now that could easily switch back if the market experiences some trouble. The latest reading of consumer sentiment shows that we dropped a little bit down to 62, and there's still a really wide gap between consumer sentiment and the 2-year yield. This chart down below just measures the difference between the two. Weekly jobless claims continue to fall. The last one came in at 198,000, below the 200,000 threshold. Continuing claims also continue to go sideways and are still pretty low overall. We'll really be watching this chart. We saw a little bit of a tick up in the last quarter of 2022. If this really starts to go up, that means that people are unemployed for longer periods of time, and that could feed into the employment situation. On a one-day basis, we probably overdid it with the advanced decline ratio. We went extreme positive. Looking back 5 periods on the rate of change, we're getting extreme positive. With the 10-period rate of change also getting extreme positive. Now, they could still go further, but they're starting to enter into this too far, too fast territory. Here's the ADX trying to turn up and is just about ready to cross over the moving average. The green line is on top and rising, so we default to the positive trend. The daily chart showing how we were above this pivot point. Now we're coming up to some more resistance at a pivot point, and we could hit the underside of this upward sloping trend line if we continue to go up. If we start to fall, we'll be looking at this pivot level right here. If we fall underneath that, there's the S1 level. Down at the bottom, you see where volume continues to be below average, even though it picked up a bit in Friday's session. That is a concern. Here's a 2-year look at that same chart showing pretty much the same thing. Our Arun is starting to go positive now. It crossed above zero, showing that buyers are in control, sellers are decreasing, so our oscillator is positive. We're starting to go up a little fast here. We're up on the upper side of the 2 standard deviation band right here. When we get up into the 3 area, that means we're going really too far, too fast. Sometimes this can mark some exhaustion in the market. The Stochc RSI continues to be extreme positive, as does the Williams percent R. The short-term stochastic, really extreme positive. Now the intermediate term is extreme, still showing improvement with the longer-term stochastic as well. The force index, not giving us an extreme reading, but is still positive in the short term. We're pretty far away now from the 20-period simple and exponential moving averages. We're above the 50-period exponential and simple moving averages, and we're still above the 100-period moving averages. Moving average tree shows us coming out of the tree itself. The Swindlin Trading Oscillator getting extreme based on price. We still have a little bit of room to go based on volume. All of our oscillators are now going higher and are positive. The parabolic SAR continues to be positive with the dots below. The Chaikin oscillator still has more room to run, even though it's positive. The Vortex, green line is on top of the red line and advancing, that's positive. Ultimate oscillator continues to advance and not giving an extreme reading yet. The Sean trend meter starting to give us a bit of an extreme positive reading. 20-period exponential moving average has now gone extreme positive. We're still seeing improvement with the 50 and 200. The CCI 14 and the CCI 20 continue to be extreme positive. The RSI in 9 periods just barely going extreme positive. Still seeing improvement with the RSI 14. This is a concern. We're not seeing a breakout in the S&P when compared to the utilities. And when we get really good sustained upward movement is when this ratio is going up. The Ichimoku cloud, we came out of the top side of the green resistance area, so that is positive. The PMO continues to be positive. The PMO study, the PMOs that are rising are extreme positive, seeing real improvement in the buy signals, and we've turned back up with the percent of PMOs that are above zero. The BPI is still negative overall, but showing improvement. We're still below 50 here. And the broader range BPI is still showing some improvement. The Chaikin money flow is going a little bit sideways here. We're following this red line. That's still going up. The balance of power is still positive and has a bit more room to run before it gets extreme. However, the CMB composite, we're above this black line here. That suggests an overextended market. The TTM squeeze is showing blue bars. That's positive. The go, no go has now flashed a signal. Unfortunately, we're overbought. And we're getting further away from the 200-day simple moving average. We broke above the anchored moving average going back to the all-time high and closed above that. That's positive. Now, can we stay above that? With the short-term fib chart, we do have overhead resistance at this 100% retracement at about the 41.25 level. Our longer-term fib chart, we have overhead resistance at 41.55. Our long-term chart, we're above the 40.20 level. Now we have overhead resistance at the 42.14 level. And you can take this chart two ways. You can see it's positive where the bigger stocks have been outperforming the smaller stocks. Now it's starting to come back down. That could be negative on one side. It could be positive, meaning that more stocks are now participating. The Elder Impulse system for the S&P is positive. The McClellan oscillator is getting extreme positive. And our broader range McClellan oscillator is also extreme positive. The summation index based on price and volume continue to be positive. We're looking better with the new highs on our 5 period going up and with our 10 period. We're seeing an improvement in the advanced decline line. Based on price, we're just shooting up. We've crossed above the moving average based on volume and is showing a little bit of improvement, but you could suggest this is a negative divergence because of the drop in volume. The advanced decline ratio starting to get extreme in our short blue line, still looking positive with the red line, which is more longer term. Accumulation distribution starting to get kind of far away from this moving average, but it's still positive, where volume continues to drop off. The money flow index, don't show this all that much. We've crossed above 50. That is positive. On balance volume, don't show this very often. We've crossed above the moving average. This is the first time in quite some time that we've been able to do that. Bollinger Bands, don't show this chart very often. We're getting to the upper side of the upper Bollinger Band that most people use. I also put another Bollinger Band on the outside of this to show real extreme movement. And here's the %B indicator showing that we are outside of the upper band, so we're getting extreme positive. We're going back above the midpoint of the trend channel, going back to 2009. Here's another look at a variation of Dow theory, where you have the S&P breaking out up on top. And we're also seeing a little bit of a breakout now with the NASDAQ on bottom. The Heikin Ashi remains positive. The Kegi remains positive. The Renko remains positive. We added a new X with the point and figure chart, but no new signal has been generated. We are positive with the 3-line break. And I've updated this a little bit. I added the 20-period moving average here. That's the short term. 50 is more intermediate term, where 200 is the long term. We're positive, moving above the 50 and 200, but we're getting extreme positive, getting above the 20-period moving average. Long term, we're showing improvement with the 150 and 200-day moving averages. The financial sector was actually down a bit compared to the S&P. The banking sector was up over 1%. Regional banks were up 0.82%. The other regional bank ETF was up almost 1%. And the ratio between the regional banking ETF and the financial sector continues to show weakness. And First Republic was up over 2%. Here's a broader look at the advanced decline line. We already looked at the S&P. We're seeing a lot of improvement with the mid caps, but we're still below the moving average with the small caps. The Dow was able to get back above its 50-period moving average, and the diamonds continue to be positive. The NASDAQ also looks to be breaking out, but getting back to this previous high. That may end up being some overhead resistance. The NASDAQ 100 is breaking out, but we also have overhead resistance above current prices. The Qs remain positive for the Elder Impulse system. We're breaking above the 12,868 level for the 38.2% retracement. Can we stay above that? If we continue to go up to this 50% retracement, that would be much more positive. The microcaps were up as well after setting a new 52-week low recently. The small caps were up almost 2%, still underneath the 50-period moving average and still underneath this pivot level. Here's another look at the Russell Small Cap Index. The MACD is positive, and the RSI has now been able to get above 50. The small caps have switched to positive, but the ratio between small caps and the S&P continue to be negative. And here's another breakdown of the red chart is going down. When this is going up, that often gives a lot of support to the blue line, which is the S&P. The mid caps also dealing with some overhead resistance, closed slightly above this pivot level. The mid caps remain positive. Here's the home builders, where we've been going up with the S&P. The home builders have been going up, but the ratio is not showing a lot of strength right now. So even though we ticked up with this relationship down at the very bottom, the correlation between the two, it's still giving us an extreme reading. So I'm still counting that as a negative divergence. The Copic curve gave a recent buy signal, as did the Pring bottom fisher. Interest rates ended up falling just a little bit below 3.5%, and bonds were up slightly. Looking at the long term, this is showing some improvement. The MACD is curling back up above this moving average, and they're both above zero. So that suggests that for right now anyway, this could always change, but this breakout is looking for real. An update of some of our possible positive scenarios. The stocks in the S&P that are above their 50-day moving average, they're showing some improvement, but we would expect this to be a lot higher given where we've risen in the S&P. And we're seeing a very similar thing with the mid caps, even though they are improving, as well as the small caps. If you go back and look at this, The S&P is in first place with this indicator, then in second place are the mid caps, and then in third place are the small caps. That's a little bit of a concern. Then looking at the percent of stocks above their 200-day moving average, it's not going up all that much either, even though it is improving. And then our 19-day exponential moving average of the advanced decline ratio shows we're extreme positive with price, showing improvement based on volume and not extreme. You could take that as positive, that we still might have more room to go. You could take that as negative because of the decrease in volume. Then the 10-day average of the S&P highs minus the lows, going above 50 and showing improvement, but you'd expect this to be a lot higher for where we've come from. And then the 5-period moving average of the highs minus the lows, they are still negative, so that's another warning sign. Our growth to value ratios looking good with the Qs to the S&P, showing a little bit of improvement with discretionary as well as large cap growth versus large cap value. Here are the large caps showing improvement with the mid caps, a little bit of improvement with the small caps. And then this is a chart I haven't shown in a while in this video. We set a low with the NYSE Brent Thrust back in October. We started to go up, and now we've been coming back down, even though we're seeing a little bit of improvement with this. If you notice up in the right-hand corner, there's a 1-day delay on this chart. So this is probably going to go up a little bit more, but you would expect it to be higher. When you work off of this signal, there is a 100% success rate looking 1 to 2 to 3 years out from now, but you might go through a nightmare just getting to that point. We're seeing some improvement with the 50-period exponential moving average of the new highs minus the new lows. It's turning back up. It's still negative, but it is showing some improvement, and the indicator itself is now breaking out slightly above zero. As long as it stays above the zero line, this previous chart will possibly go back positive. The 2-year Treasury yield, after spiking up and coming back down, that's where we got some of the support from in stocks. And the staples, the S&P 500, it is starting to come down, so now we're wondering if one of these spikes right here could give us some support of the market. Unfortunately, we are quite overbought and we're not trending right now. So the idea that this could go up and create a new spike is very viable at this point. What's our outlook for Monday? The stock market will be closed on Friday in observance of Good Friday. The technicals are positive, but we're overbought. We have the IHS Market Manufacturing, the final reading coming out on Monday, and construction spending. The whole list of geopolitical events. Right now, it's about inflation and interest rates as far as the stock market is concerned, as well as is there going to be any more banking news that's either positive or negative. We have 2 speeches. We have the same person giving both speeches. The speech on Monday will be after the market closes. On Tuesday, it will be more of a virtual session between Lisa Cook and whoever's listening to her. Now we have the new statistics for April. As far as the Dow is concerned, April is the best month for the Dow going back to 1950. I have another chart that I'll show in the weekly video from Edward Yardeni that shows it's the second best month. The Dow is up 16 straight years from 2006 to 2021. The Dow shows strength after tax day. Earnings expectations for the first quarter lead to optimism before earnings are released. This is buy the rumor, sell the news. That's kind of built into what happens in April. April tends to be rarely a dangerous month, but there are 4 exceptions, with the most recent being 2022. The best 6 months that the Stock Traders Almanac has their own strategy for, it ends with April. And since 1950, the S&P return during pre-election years is 3.5%. Later in the month, when we get to options expiration, the first day of options expiration, which is a Monday, it's virtually a coin toss. It's up 51% of the time and down 49%. On options expiration day itself, we're up 63% of the time and down 37%. And then for that whole week, we end up being up 70% and then down 30%. The week after options expiration, it's just a flip-flop. We're down 63% of the time and up only 16% of the time. Then for the month, on April 3rd, we have pretty positive seasonality coming in here for the Dow, S&P, and NASDAQ. They're up 61.9% of the time. That's positive. And then the best years, going back 73 years, we're up 71.2% of the time, down 28.8% of the time. And then I've taken this yearly information that I typically go through and put it on a separate slide to try to make it a bit less crowded. Then here's the chart for April. We're looking at the green line right in here because this is a pre-election year, which tends to be positive. Then I just shifted the pre-election after midterm bear over to April. That tends to be positive. We're still supposedly in this sweet spot for the S&P, but then we start to see some weakness in the near future. So our scenarios. Can't really go with the down one because we're going up, even though we're very overbought. Unless you're very aggressive, then you might look at doing some kind of a counter play. Can't really go with the up one because we're overbought. And then overall, we continue to be trendless because the ADX, although it's getting stronger, is still below 20, although it is positive. So our conclusion, the S&P is positive but overbought. Short term, intermediate term, positive and overbought. We are positive in the long term because we're above that 200-day simple moving average. And some of our long-term indicators are showing some improvement. Thank you. I hope you found this helpful. I will be preparing the weekly video and the intermarket analysis video as well as the deep dive video just as soon as I can. I have some other things happening this weekend. I'm actually recording this later than usual because of these other things that are taking place. I'll get those prepared, recorded, and posted just as soon as possible. I hope you have a great weekend, and I will talk to you in the next video.